says the Philippines can't afford to follow Vietnam's route, committing to remove tariffs on U.S. goods. With us now is Melissa Lopez, Chief Economist for ASEAN at Lundgreen's Capital. Good to see you again, Mel. Welcome back to the program.
Thanks for having us, Kathy.
Okay, so you're recommending the negotiating team to offer opening up our market to U.S. goods. Why?
Well, we have more to lose on both ends, more than exports more than imports. So exports, U.S. is really our biggest export destination. So a lot of our manufactured goods, particularly electronics, which is our biggest product, really goes to the U.S. So we have a lot to lose. Our exporters have a lot to lose if they get slapped a 20% duty. Meanwhile, on the other side of it is imports. U.S. imports do account for just 6% of total imports in the country. And actually, in terms of value, it's less than 2% of GDP. So even if we let go of the tariffs that we impose on U.S. goods, there is room to accommodate that just so our exporters don't have to suffer more, Kathy.
Yeah, but don't we have more to lose if we're talking about opening up the agricultural sector? I mean, I've just spoken with PCCI Sergio Ortiz-Luis, and he said the agriculture sector cannot afford to do so anymore.
Well, a relaxation in tariffs would have to come with corresponding domestic efforts to support our local producers. Of course, it has always been the call, right? But this more than ever should trigger a strong response as far as supporting the competitiveness of local industries, especially of our farmers.
Right, and speaking of farmers, well, Jonas Ravelas of Reyes Tacandong has this view that if we open up for wheat and soybeans, that's going to be good because they're primarily used in feeds. So we got to be selective. Wouldn't you agree?
Right. At the same time, our local capacity should be able to match both quantity and quality. So that's the question as well. We do prefer, of course, local production when possible, but at the same time, if we do have to make some concessions to escape that 20%, really high 20% tariff that they want to impose on our goods. So if that's what it takes, we should match this relaxation of our duties with a corresponding capacity building, or maybe, of course, government is allergic to subsidies, but yeah, that would be, it has to come side by side.
Allergic to subsidies, that's kind of a light way of putting it. But yeah, because if we let go of the agricultural sector, then that has an impact on inflation and then the purchasing powers of people. So just taking that into context, how might whatever's agreed upon on or before August 1st influence the Monetary Board's decision policy on August 18th? Because we're keeping an eye on that. And on the level of inflation we're at, still benign at 59-month lows, but could change because of what happens in the negotiations.
Mm-hmm. Well, as far as imports, if we do let in more imports from the U.S. at cheaper or maybe zero tariff, depending on what comes out of the negotiations, it will actually somehow ease inflation concerns. And actually, we're at a low 1.4% last month. So there is more room for the BSP to consider more rate cuts. We're seeing at least one, at most two rate cuts of 25 basis points each for the rest of the year. So we are seeing that growth has been strong, domestic growth has been strong, but there's room to support it further by lowering interest rates.
How much of a limiting or supporting factor is whatever the FOMC does at the end of this month, given inflation figures are out later tonight and the resilience in jobs that we've seen last week? How will the Bangko Sentral ultimately decide when it considers what the FOMC will do?
Mm-hmm. We do see that the Fed will not this year. I think that is more bullish than the rest of other, investment houses. But regarding the BSP, our domestic conditions are performing better than how the US is unfolding. We did manage a 5.4% growth in the first quarter against a contraction in the US. So in terms of relying on the FOMC for cues, there is more space here to cut relative to the Fed, although, of course, they will remain watchful about the effects of high interest rates in the US.
Well, let's take a look at your portfolio, because since the last time you were here, it was different. Now you've changed your risk rating towards the U.S. from overweight to neutral. What triggered that? And what do you think is going to compel you to change that again in the remaining months of this year?
Right. So we actually changed last April from overweight to neutral. Overweight has been our rating since 2022. So about 3 years overweight towards the U.S. But really, we find the US assets less attractive due to the very high volatility caused by the trade war. We find that Trump's trade war has hurt the US economy the most, even more than its targets like China. And that makes this uncertainty really makes us concerned about the returns that investors could realize from investing in the US. And our allocation instead is to add more alternative investments to our portfolio towards Europe, but selectively. So we prefer adding more alternative investments to our portfolio, and that means acquiring shares in non-listed high-growth startups in Europe. So that's where we're going towards, Kathy.
Right. It's so interesting because it's so nuanced. It's non-listed high-growth firms and in Europe, and the defense companies are those invested in defense. What impact would that have, though, in your Asian investments and as a sub-region, the ASEAN, where the Philippines is?
Not defense towards this part of the world, but still high growth sectors. So we do prefer new energy investments. So that's tech, high tech,
Okay.
and AI support regarding software as well as the production.
Got that. So that's tech, IT, and software. And apologies, we've had a little bit of a hiccup in the connection there, but I'm so glad to get your insights. Melissa Lopez, Chief Economist for ASEAN at Lundgreen's Capital.